In this video, I'm going to explain the three trades that we executed that I called out in the chat room, which were, for the most part, breakout trades. I'm going to show you how and why I call them breakout trades. Some of them initially set up with some slight reversals at highs or lows. I'm going to show you the whole thing today. So I've been receiving a lot of questions. This is the reason I decided to make this video. I want to share this video with you to give you a lot of free information, free value. I want to show you that the methods and the thinking behind this strategy. I've been using these strategies since 2001. I developed this method back in 2001, and I know that a lot of you are probably trading in a similar manner. Very often when I get subscribers or coaching students, they'll say to me, one of the things that really piqued my interest in your educational services and coaching is that I am trading and doing things very similar to what you're doing and showing in the videos. I just didn't put enough detail and enough structure to the plan. So that's one of the things that I've noticed with a lot of my coaching students. I started trading in 2001, but I started coaching in 2007, and I started off with a chat room in 2007. I started calling out trades just like I am today with these trades that I'm going to show you today. I called out these trades inside of the chat room. And again, very often, a lot of people will say, I've been trading for a little, for a few years, and I just didn't put enough, structure to the plan and the systems, and I understand what it is that you're doing. And that's usually the people that go into my chat room. They watch some of my videos and they see what it is that I'm doing, and they're trading in a very similar manner. So one of the things that I hope you get out of this video is not only a better understanding of how I trade it, how I call out trades in the chat room, but if you are trading in a very similar way, this is probably something that's going to resonate with you, and you would be a really good fit for trading with me in the chat room. So I started off, there was a live trade that I was able to record. And obviously, if I'm in a chat room and I'm working with coaching students and I'm calling out trades, it's not always easy for me to immediately turn on some kind of a screen recording program, because I'm calling out trades and I'm showing my charts and I'm working out all of the details of the trade as it sets up. And then I'm answering questions, because there's always going to be questions from people in the chat room. And that's one of the first things that I do. And I strongly believe that if a member, a coaching student, somebody in the chat room has a question and they're about to get into a trade and they're using my trading system, and maybe they don't have a full grasp of that trading system, if they have a question, I strongly believe that it's my responsibility to stop right away as quick as I possibly can and answer that question if I see it pop up right away, because I need to do everything that I can to prevent someone from making a mistake if they don't have a clear grasp and understanding of my trading system. It's my trading system. I put it together, so I've got to present it and explain it in the most clearest ways that I possibly can, showing example after example and why I'm doing what I'm doing. So the video yesterday was a live trade. Obviously, it's Saturday. The market's closed. But again, looking at all of the emails yesterday and then this morning, I decided to go ahead and put this video together, and we'll go through all of the steps. So this was the euro dollar, and I had that recording here. I think at the time, I don't even think it had hit this first price tag here at 1.1080. The target was 1.1100. Now, one of the first things that I will say is that when I'm in the chat room, I'm calling out these trades live and I'm showing the price levels on the charts on the screen. You get to see it. So for example, when I get into a trade, and I call it out and I'll say I'm buying euro dollar right now at 1.1071. The first target is 1.1100. And if it takes out the 1.1100, the second target, another target would be a psychological level. I trade two psychological levels in situations like this where I don't have a clear relative to this time frame. I don't have a clear A-B price swing where I could use the Fibonacci's to determine where the extension targets are. Otherwise, I use extension targets over and over and over again, and they work perfectly. I mean, I've been using them since 2001, and very often the extension targets, if I have the ability to draw that A-B price swing where the Fibonacci tool would fit here, which it does not right now, but if it did, very often those extension targets will line up with some of the expected take profit levels based on the technique that I'm using anyway, and some of these psychological levels. Not always and not exactly, but you get the point. For the most part, it does give me a clear indication of where I should trade it to, where I should expect price to go to, and what to use as a price target. So we also scale out. I'm going to show you examples of scaling out. in just a moment. And that's a critical component to my trading system. In 2001, when I first started trading, I was just looking for one target, and it didn't matter how many lots or how many contracts I had. I also trade futures. It didn't matter how many I had put on one position. I would just close the trade at one target. And I was still experiencing a great deal of losses. So I hired a professional psychologist who exclusively worked with traders. And one of the first things they asked me in the first week the first session was, are you scaling out of trades? And it was such an important component. They didn't help me. The psychologist, they didn't help me put together my trading strategy. That was up to me. But they helped me implement ideas and concepts that would guide me through the trading process, where I could not necessarily ensure that and guarantee that every time it's going to be a winning trade, but that I was going to be making some profits along the way if it didn't hit its expected take profit level. And they told me that every successful trader that they ever worked with always scales out. And a lot of them even have methods to scale in and scale out. So in a situation like this, if you're going to get into a trade scaling out, you're obviously going to have to put more than one lot. If you're used to trading one, let's say, mini lot, then cut it in half. And then that way you could take two positions, and that way you're not exposing more than what you're used to on a trade, and then you would take profits at these two different levels. I'll show you what that means, because in this instance, with this particular trade, there really wasn't a whole lot of scaling out. It's just that when price reaches some of these take profit levels in the chat room, I call them out. I don't leave anything to chance. I don't like mute my microphone and walk away and hope for the best and things like that. I'm talking as all of this is happening, so everybody in the chat room knows exactly what it is that I'm doing. And when price does hit a price target, I will say, all right, everybody, and even moments before or a few minutes before, when it looks like it's approaching a price target or an entry, I let everybody know that I'm about to get into the trade. I want everybody to have the opportunity to get into the trade so we can all take it at the same time. And then I help them. It's my trading system. Again, I'm trading with you side by side virtually, walking you through each one of these strategies. So when it approaches this level, I'll tell them, well, it looks really strong. I'm going to wait until this candle closes. Very often when a candle closes after a move like this, we can see that there's usually, not always, but if it's a strong move like this and some kind of a reaction, which it was on Friday, for those of you that aren't aware, it was Powell's comment. Markets were waiting for it. You can see that there was a lot of consolidation here on the euro dollar for quite some time. This is the 1 hour chart, by the way. So it gave us a really opportunity. The markets were waiting for that particular statement and that announcement, and then looking for the opportunity to trade it if there was one there. It's kind of like trading off of FOMC, right? We know when it is, we know when it's going to be released, and then we need to go through the statement and identify key points in the statement, and then place a trade. And then, for the most part, we're going to be trading with the rest of the market if there's going to be some kind of reevaluation, which there was. So as it's approaching some of the targets, again, very often on a strong move like this, I'll usually say I'm going to hold for the last few minutes of a candle, because very often with the last few minutes of a 1 hour candle or a 30-minute candle, when it moves like this, we get that push right towards the high in this instance that it made. And it'll close towards the highs, that's exactly what it did. So it was okay to hold through that 1.1100. Otherwise, that would have been the target and the final target, and I would have closed it myself, and I would have recommended, that's our target, I'm done, I'm flat. But when it pushes through, now I know we're running into this resistance. This is a big move. This is just 1 hour reaction. There's probably going to be another hour or two afterwards. So this was our second hour, and then it continued to the second take profit level, finally reaching and getting really close to the next level after the 20 was 50. It didn't hit 50 and started to pull back, and I closed and called out the trade flat, at least in my opinion. I said, guys, I'm going to take profits here at 1.1130. It was approaching this R2 level at 36. Sometimes it'll stall just before the 50, and other times it'll move just like this. Last few minutes, or the last hour or so of trading, it'll pop right through. You never really know. And getting in at 71 and closing at 30 here is a big trade. That was a really great trade. So why risk it, right? Why risk it and hold for every single last pip when my next target is 50 and I don't know for sure that it's going to reach that level? It's already covered quite a distance. So again, when it was starting to pull back down, I said I'm going to close it here at 30. I'm flat. You guys can hold it. I recommended that anybody who was going to hold for the next target to put it at some kind of a not necessarily a break-even stop, but if this is the last level that I used as a price target, if it pulls back, I would recommend not letting it go any lower than that, because you don't want to give away all of that profit from 71 to 30 here. Again, last hour or two, of trading, it pops right up to the 50. That was something that, nobody could really. It's better to be safe than sorry. Why give back all of the profits if it just doesn't go anywhere, or give back another 20 or 30 pips in profits? So that was the euro dollar. But at the same time, we had other trades that were developing. What set all of this up was this range of consolidation. I use a strategy. I created this. It's called the continuation breakout trade. And I'm going to tighten this up. And you can see that this is a range of consolidation. This dotted line right here is the start of the week. This is my range of consolidation. And I use this technique on the 1 hour chart. Not the 30-minute. I do use it on a 4 hour. It works on great on a 4 hour or daily. But for day trading, I use it on a 1 hour chart. I'm not going to explain the details why I don't use it on anything smaller than a 1 hour chart. I explain all of that in the chat room as we're going through this process. But right now, just to save time, just to get you through this video so you can understand what it is that I'm doing, and maybe you can see some of these patterns and you can trade them yourself. There was a continuation signal candle here because it finally broke down below the weekly low at that point. But there was a lot of divergence in that in these indicators, and it looked like it was going to reverse and go back up. Now, this isn't the template and the appropriate indicators that I use for identifying reversals. So I've got both of them in here. I've got the CCI, I've got bandwidth. I use this to save some time, this particular chart, because I know that if I'm going to get a breakout, there are certain indicators that I need to confirm, and if I'm going to get a reversal, there are other indicators that I need to use to confirm. So I sort of do a little bit of both, but I offer my templates to all of my chat room members too, so that they can use the same indicators for each one of these different strategies. Because if we're trading a reversal, we need certain indicators, and if we're trading a breakout, I need other indicators. So these templates, I make them available for the people in the chat room, so that way they can do the same thing I'm doing and see the same thing that I'm talking about in the chat room with the setups. So it was pretty clear that it was going to be a reversal. At that point, I just needed to wait for it. So I waited for a 5-minute bar after it printed the reversal, and then I got the break of the 5-minute bar. It took a little while, but it finally did give me that break at 71. So this was what I call a Tech 1 trade. I gave it that name. I know it sounds kind of weird. When I was putting together my methods, my trading strategy, I was doing it all by myself. And I did a video I was video documenting everything I was doing. I had a video camera, and I put it on a tripod, and I plugged in a microphone, and I pointed it right at the screen, and I basically recorded everything that I was doing. I didn't know anything about Camtasia or other screen recording software, because I wasn't teaching anybody. I was just doing it for myself. And then I also kept a written journal. And as I was piecing together some of these different strategies, this was going to be a reversal, I needed to give some of these patterns and some of these techniques a name. The continuation breakout trade is obvious. It's a breakout, and then it's a continuation of the in the same direction of the breakout. So you're expecting it to continue to trend in the direction of the breakout. This was a signal candle for a continuation breakout trade, but it wasn't confirmed, and that's why I didn't even consider selling it. I could see that it was likely to reverse. So this reversal, it's a technical trade. I can see the technicals in here, but very often it's either economic data or political statements or what we had yesterday from Powell. Whatever the case is, whatever the market's waiting for, that event is usually what drives price to those targets. The same thing with continuation breakout trades. Very often I'll get continuation breakout trades with non-farm payrolls or economic data, and then it'll break out of a range of consolidation and then rally for about 2 to 3 hours. So this is what I call a Tech 1 trade. And again, the Tech 1 trade is a technical trade. That's what I wrote down the first time I was outlining the details of this trade in my journal. So it is basically an evening star or a morning star or a bullish or bearish engulfing candle at a support or resistance level. Sometimes it'll move like this. This is also something that I call a T2 pattern. So there were different versions of these reversals. Sometimes reversals will take place at support or resistance, and then other times they sort of move out of a range of support or resistance, and then they print this reversal like this. That's exactly what I was trading off of. And then each one of these strategies, because you can see different levels here, each one of these strategies, again, the continuation breakout trade uses a specific target, and then the Tech 1 trades use specific targets. And I am going to show you an example of the breakout trade, the continuation breakout trade. This is the Tech 1 trade. So in other words, again, the T2 pattern, it's just a spike low or a dip low in price, and then these indicators start showing clear divergence. Very often, something like this will set up right around a major support level if we're going to trade a bounce off of support, and then you get that clear reversal candle pattern. It's a bit tricky sometimes because you've really got to be paying attention to certain things, and I'm going to show you what we were using for confirmation. And because sometimes it looks like right there, if you look at where it reversed, it looks like it's retesting the level that it broke out of, which was this old support in place from Friday and then all through last week. It looked like it was just going to hold there. So if you're going to go long, it looks like, well, maybe you could run into a problem and it'll turn around and go right back down again. But that's not what was happening here. There was confirmation in the dollar. Very often I'm going to be looking at the dollar index, and I can see the resistance or support levels on the dollar index that will confirm a possible reversal. So let me go to the dollar index and show you exactly what that looked like at the time that this was setting up. All right, so this is my dollar chart. This is the US dollar by itself, and this is the 1 hour time frame. And we had this resistance area at the sort of towards the just shortly after the beginning of the week. So for the most part, again, this looked very similar, just in the opposite direction, what we were seeing on the euro dollar. Just a range of consolidation that lasted for most of the week. And there was a lot of talk that the dollar was likely to go up higher, but with that high here from the 20th, August 20th, it never really went any higher. It trailed, a little bit higher, and there was a little bit of a movement in here. Some people like to scalp that. I don't. But when it held, there were 3 1-hour candles that were finding resistance right there. And then we got that reversal candle pattern right here. This is that evening star pattern. That was developing at the same time. Notice how with this one, it never spiked through resistance, making it look a little more confusing the way it looked here with the euro dollar. Here on the euro dollar, it looked a little tricky. It looked like maybe it was going to break down and start moving to the, resume that downtrend. And it looked like this reversal was just a retracement to the level that it broke out of, and maybe it would hold prior to the announcement. That's what it looked like. But it was very clear and very obvious that this was not doing the same thing. Very often, the dollar index is going to give me the same pattern that I look for when I trade the currencies, and I'm walking through all of this step by step in the chat room. This is exactly everything that I'm sharing with you right now, how I pieced together each component of confirmation for this trade, or these trades, the 176 total profits on the 3 trades. That was the title of the video. But this is exactly what I was going through. I was going through step by step in the chat room, showing them, all right, at this point, it looks like it's just holding here. I mean, we can see clearly that resistance is holding, and we've got 3 candles here at resistance. It's not spiking. I was comparing it to the euro dollar, how it spiked through support. In this case, it didn't spike through resistance. It wasn't following the same pattern. And then I could start to see that resistance in the divergence in the indicators. And at that point, it was just a matter of waiting for these candles to start printing reversals, which it did, and it gave me the same pattern here on the euro dollar. And then I just waited for that 5-minute break. And then eventually, when the statement came out, it spiked actually lower initially. So we had a stop. Let me talk to you about my stops. So an entry of 71 with the stop at 50. The low of that candle was 51. The spike low went to 52.2. So it did not get stopped out, and then it immediately reversed and went right back up again. Spikes like that happen. They don't always happen, and sometimes they don't happen that deep, but in this case it did. Very often in a situation like this, we want to be really careful with our stops and be aware. You don't want to be putting on a trade like this and then maybe putting on a 10 or 12 or 15 pip stop when it isn't below the price swing low that created that opportunity. And there was a lot of upside potential if his statement, Powell's statement, was actually going to be a market moving opportunity. It was likely to create the breakout. Now notice on that first candle, that candle doesn't close above resistance, printing the continuation breakout trade. But what allowed me to continue to hold onto this trade, remember how I said that very often on a strong move like this, I will wait for the last few minutes of a 1-hour candle to see if we get that last push towards the close, where it closes towards the highs in this case. But at the same time, the dollar, sorry about that, the dollar printed the continuation breakout trade right there. the dollar actually closed below that support low, and it printed a continuation signal candle. Now, obviously, you may not be able to trade the dollar, but you use the dollar. I use the dollar as confirmation. So this was my continuation breakout trade on the dollar, and I knew that it was likely to go even further, which allowed me to, again, hold on to this position. Even though this one didn't print, I knew this was going to follow. Sometimes they'll do that. One will take off and print the actual trade signal that I need, and then another currency pair or the dollar or something to that effect will develop afterwards. So that's exactly what I got here with the dollar. I got my continuation breakout trade. I knew it was going to go lower. I follow the same rules when I execute the continuation breakout trade, but I apply it to the dollar just to make sure that I have confirmation and I'm trading in the right direction when I'm trading the four majors. So again, it picked up and then it continued right through, and then the dollar continued to do what it was supposed to do. The very next candle gave me the 3-pip entry, and it continued a lot lower. On this platform, on some platforms, you can trade the dollar. I trade Japanese yen futures. I'm going to show you the next trade. So this trade here, again, 71, and then the final target was up there at 30. So the Japanese yen, dollar yen. So the dollar yen, let's take a look at this one. And I was using, if you haven't watched too many of my videos, whenever I trade the dollar yen, I trade Japanese yen futures. I do trade futures, and I use the same system. And in the chat room, I will call out trades with futures because some of my chat room members, they can trade futures. I do trade index futures. I trade gold and oil, silver, and Japanese yen futures. When I trade the dollar yen, I need to be looking at the Japanese yen futures because I'm going to execute a trade on the Japanese yen futures, but I get a lot more depth or transparency. I get to see a deeper look into the strength or weakness of the moves with the yen because I'm looking at Japanese yen futures. I'm going to explain exactly what I mean. So this is the dollar yen. Dollar yen, I detached the charts here. So we had this range of consolidation all week long. Basically the same structure that we saw on the dollar index and the euro dollar. Consolidation all week long. And it moved up to retest that level. You can see how it stopped. There's one of the highs from the previous week, but the crosshairs here, there's this week's high. So it was stuck right in between those two levels. It did not take out the previous week's high or the actual high of consolidation that I was using here. That was clearly my indicator. If it was going to print a candle above this resistance and then rally higher sometime during the week, it would have needed to close above that high. That's the actual high. That was an event the week before that caused that spike, and nothing had gone any higher and not too much lower than that situation. Whatever that event was, whether it was economic data or statements or comments, whatever it is, you can see it technically here on the charts. This is a 1-hour chart. Then I get the reversal. Now, obviously, it was showing and printing some divergence prior to rolling over. Very often, this is a 1-hour chart. I will also be looking at the 30-minute chart because sometimes the 30-minute chart will give me a heads up. This is a 1-hour candle, so you can see how it engulfed. It printed a bearish engulfing candle at resistance. And where's my confirmation? Well, the dollar was also confirmation because it was also reaching resistance at the same time. These are the indicators that I use. I'm going to be using bandwidth. There's %B. I also look at divergence here in the CCI, but I mentioned that when I trade the dollar yen, I need to be looking at Japanese yen futures. Let me show you the Japanese yen futures when it reached that critical level of support or resistance. So this is my Japanese yen futures chart. I trade Japanese yen futures at the same time that I'm trading Forex and the dollar yen. This is not a cross pair. This is just Japanese yen strength or weakness. When we see price moving up on this chart, it's yen strength. When we see price moving down, it's yen weakness. So this price moves in the exact opposite of the dollar yen. When we see Japanese yen strength here, as we did yesterday when we took these trades, we see the dollar yen dropping. That's what we see here. So again, back to where all of this sets up. We've got a spike low. We've got another low during the week, and then everything goes sideways. These were the two levels. If price was going to close below down here, indicating maybe more yen weakness, a 1-hour candle would have needed to close below both this low and that low, both clearing both of them. These are really obvious locations. There's also another spike low back over here to the left a few days prior. But again, it would have needed to close below, but it didn't. So we won't even talk about that. I just want to talk about what it did. And again, my analysis, the way I'm showing you here in this video, it's exactly what I do step by step in the chat room. Everybody knows exactly what my thinking is and why I'm taking this trade. Now back to the yen futures. One of the reasons why I think it's so important to be looking at Japanese yen futures when you're trading the dollar yen or the yen crosses is that I talked about I get more transparency. I get a deeper look into the strength or the weakness. I'm not looking at tick volume. I'm looking at true volume. This is, again, futures. Futures. So we're getting true volume levels here in this volume indicator. When price, let me open this up. When price came back down to this level of support and then printed that reversal, just like we saw it on the dollar yen. Here's the dollar yen. It printed the same move right there. It went up to resistance and then printed that strong bearish candle, that reversal candle. It was the same move. It went right down to that support, very similar to the dollar. It didn't go any lower. It didn't make it confusing. It made it very obvious that it bounced right off of that support low and then reversed. And notice the strength of the volume on that reversal candle, pushing it right off of that with a lot of velocity, a lot of participation, a lot of volume on this trade. Now, that was the confirmation that I needed. If you were not able to trade Japanese yen futures, that's okay. You can still use this chart and look for the same patterns that I'm looking for when I'm trying to trade or when I'm trading for currencies, the dollar yen. It's the same thing, but you need more confirmation. You can't get the same level of confirmation with the MT4 platform and a few, generic installed or customized indicators. This, again, going back to this, there's no mistaking that there's, for the most part, real volume behind this move and a bounce off of this support, and it's likely to continue. And again, this was prior to the statement. It was already moving. Sometimes you see that. People will say, well, why is it moving? How do they know that it's going to be moving up before he even says anything anyway? And it's just the collective, when you look at a move like this, I very often think of the psychology behind the masses, right? Collectively, all traders at that moment that are trying to put on positions have determined that it is likely to be a statement that would be yen strength, dollar weakness, euro dollar strength, whatever the case is. That's the way we trade it. So that's you can clearly see the psychology behind whatever it is that you see even before the economic announcements. Very often before economic announcements, maybe an hour or two, we get that. It's almost like people are starting to put on some positions because they've either done enough of their own personal analysis or others that they follow have done analysis. Like you can pay for services like this. Some of them are very expensive if you're following some really good professional analysts. And then also it's just a matter of, everybody else collectively. They're watching TV, they're reading blogs, they're reading tweets. And you can see the entire thing start to collectively move into that sentiment, right? Their belief in it's likely to be a move that would generate an opportunity like this, and this is what you see. It doesn't always show up like this, but most of the time when it works like this is exactly what it looks like. We can see that shift in the market's expectations, and then that collective decision where really everybody gets in. Everybody's starting to, in other words, the needle's starting to tip more in favor of a move like this because more and more people have more belief in a move higher. That's what I'm getting at. And then finally, the statement here, you can see more volume levels, clearly closing this 1 hour candle, closing above that resistance point. There's my consolidation. It's the same thing. This was a continuation breakout trade right there. And when I trade the futures, I would either trade off of a Tech 1 trade off of support, and if I miss that trade, well, the next opportunity, if I'm looking at a range of consolidation like this, is to wait for the 1 hour candle to close above the resistance of the consolidation, printing what could be a continuation breakout trade. And then if it's a continuation breakout trade, then I would expect it to continue in the direction of the breakout. Looking at volume levels for confirmation, and that's exactly what we saw here in the dollar yen. There was the Tech 1 reversal. If you don't trade off the Tech 1 reversal, and in this instance, I did not call the Tech 1 reversal. Everybody was waiting, and I said, look, the way this looks to me with this range of consolidation, I'm going to wait until the next clearest opportunity for me, which would be a continuation breakout trade. Now, some people would say, well, you're giving a lot of data here, or pippage, your profits from 106.50 to 16. That was a big move. It was going to be a big move regardless. The keys were in identifying what was going on here in the yen futures and also in that dollar chart. And the fact that we've been inside of consolidation for a long time. There's a general rule of thumb that it's not, I can't even call it a general rule of thumb, but it's what a lot of people like to use. And what they'll do is they'll say, if a range of consolidation has been in place this long, so if you look at it, let's say if you were to stick a ruler on the screen and you were identify where it started, where consolidation kind of started. I mean, obviously with that peak high, but right about when it started to settle, right around here. So if you were to measure from this distance all the way to the last area before it broke out, they take that distance and turn it on its side, and then they measure the distance down or up, and that would be their target. I don't generally like doing that. I don't think it's a good idea. I don't think that you could really expect the dollar yen to rally on a move like that 200 or 250 pips or something to that effect in a single day. Maybe over the course of time, and you would have to switch to a larger time frame to actually make it comfortable where you can really see the bigger picture. But if you're day trading and you want to get in and get out, we can't justifiably expect the dollar yen to move 250 pips. That does not usually happen, even with big economic events or big political statements or events or Fed statements. It just doesn't happen. So what I do is with I mentioned earlier, the two different strategies. The Tech 1 trade has specific targets, and the continuation breakout trade has specific targets. I'll talk a little bit about the continuation breakout trade and its targets. On the four majors, euro dollar, pound dollar, dollar yen, dollar Swiss, when I trade a continuation breakout trade on the 1 hour chart, from the point of entry, which is a 3 pip entry, I'll talk about in just a minute, I use a 55 pip stop and a 55 pip target. And I scale out at the first 20 pips along the way. So remember earlier, I said if you're going to be scaling out, but you're used to only trading one lot, that's what I did in the beginning of my trading career, cut that one lot in half. So if you're trading standard lots or mini lots, just cut it in half and open up 2 positions when you get into the trade. That way you can lock in profits at the first target and then let the second half of the trade go to the second target. I'll explain exactly what I mean by that. So again, I'm not using that idea where people will take the length of time that it was in consolidation, turn it on its side, and then measure the distance up or down. Again, over time, if you're going to hold for maybe a day or two, it might cover that distance. But for day trading purposes, I want to get in, get out, and I want my profits. If I'm going to get a 55 pip target or a 55 pip trade on this, that's a good trade. No one's going to argue that that's a good trade. And if I'm trading standard lots at $10 a pip approximately, you see my point. You're making really good money. I'm not giving any of that back, and I want to get paid. If I've been waiting for 2 or 3 days watching this range of consolidation and I really haven't had too many trading opportunities, when this happens, I want to get paid. I'm not going to hold another 2 or 3 days to see what happens next, especially in this market in these market conditions, market environment. Market's jumpy, jittery. It turns around on a dime and goes 180 degrees the opposite direction just because of a tweet from Donald Trump. The last thing I want to do is leave my trade open when I was up 55 pips and then give it all back because he says something on Monday or Sunday. And as a matter of fact, he's been saying things after the market closed anyway that's probably going to cause some kind of a reaction and maybe even a gap when the market opens. And the last thing we want to do is be on the opposite side of that if we're holding for this idea where price is going to go in the direction of the breakout, the distance that it was, or the length and the length of consolidation that it was in. I don't want to take that. Doesn't. I see that it makes sense, and in some cases, like I said, it does work. But you're going to be holding onto the trade a lot longer, and I don't want my money with an open position exposed to the markets and the volatility and the how everybody is just making a comment and then retracting what they said, and we see these wild spikes going up and down, and no way am I going to give it up. So 55 pip target from the entry. There's the first target, there's the second target. The second target is the final target. That's 55 pips from the entry. So I called out this trade 105.94. First target is 105.74. That's 20 pips. And then if it continues, the final target is 105.39. That's the 55 pip take profit. Now, I mentioned that I use a 3-pip entry. I developed this strategy with this breakout, this continuation breakout trade, and it was a step-by-step process. The first thing I needed to do was figure out which one of these candles is going to give me the accurate breakout. I didn't know. It was weird. I was in a chat room and people were calling out trades when price would take out highs or lows, but they were head fakes. So I was trying to avoid head fakes. When I went off on my own and I stopped going inside of chat rooms and I'd had enough of losing money, I needed to figure out things. So I didn't even place any trades when I was trying to figure out how do I quantify consolidation. So I have some real specific rules that allow me to identify highs and lows of consolidation on the 1-hour chart because it needs to be an appropriate size. From the highs to the lows of that consolidation, it has to be an appropriate size. If it's too small, it will generally lead to a head fake. And then I need the next step after I figured that out was to figure out, what time frame should I use and wait for a candle to break out of? I mentioned that I don't use it on a 30-minute chart. The reason is I started off using it on a 30-minute chart and looking for the breakouts. And very often, let's say that this candle opened at 10 and closed at 10:30. The next candle that opens at 10:30 to 11 goes back up inside a consolidation and ends up being a head fake. So when I switched to a 1-hour chart, I was eliminating a lot of the head fake moves because it would be a spike, but the candle never closed outside of consolidation, and that stopped me from getting into a lot of my head fakes just by switching to a 1-hour time frame. It was that dramatic, and it's that reliable, and it's been like that since 2001 when I created this method. So that's why I wait for the 1-hour candle to close before assessing the conditions. Now, again, back to, some people go, oh, you should have got in up here. Yeah, probably, but if I want to wait for the next opportunity, this is safer to me. This is 90 to 95% accurate as far as long as I do everything I'm supposed to and execute correctly, and I'm not missing anything. In addition to, we had some serious economic, I'm not going to call it economic data, but we had a serious event that the market was waiting for that caused this reevaluation across the board and had a reaction across the boards just about in every market. I also called out a trade with gold futures as well. So, and then another yen cross, but I didn't include that in the 176, the 176 pips that we earned. That was just with these 3 trades. So once the candle closes, I need to look at these indicators to make sure that they're giving me confirmation. I don't use bandwidth, but I do use the CCI and the MACD histogram. So there cannot be any divergence, and then the Bollinger Bands have to be separating away from each other on that closed completed candle. At that point, then I wait for a 3-pip entry. So the low of that candle, if I'm getting in at let's say 94, 94.9, 95, if I'm getting that, then the low of the signal candle is 98. So I need to wait for the 3-pip entry. And the next candle gave me the 3-pip entry. It moves down. It hits the first target there at 20 pips profit. I don't include the spread because everybody's using a different broker. I know that everybody's using a different broker in the chat room. So I just tell them when I see price hit 74 and it's 20 pips from the entry, that's our first target. So at that point, when I got into the trade, I told everybody, I'm getting in. I'm selling dollar yen right now at 105.94. First target is 105.74. Second target is 105.39. I'm using a 55 pip stop loss. Well, in this case, obviously, we weren't having to really worry about the stop loss. There wasn't even a retracement to the level that it broke out of, which sometimes happened, but not on this, not with this reaction, not with this event, not with what we were waiting for and how there was a clear shift. So again, having 2 lots on the trade, you close the first lot at the first target, and then you set the second half of the position at a break-even stop. At that point, then we would move the 55 pip stop down here to, if you've got a 1 pip spread on the dollar yen, it would be 93. So if price did go back up to 93, you'd be stopped out. But if it doesn't, and it just continues to move, the final target here is the 55 pip profit. So I recorded this. Yes, effectively, if you're using 2 lots, you're getting 20 here and then 55 here. So you're earning more than 70 pips. But I record this as a 55 pip target or a 55 pip trade profit from the entry to the final target. That's the way I look at it. And then it sort of stalled. And then here's the close on Friday. And then the other trade was the dollar Swiss. So the dollar Swiss, again, was a little bit different. It was similar to the breakout that we saw in the not necessarily the breakout, but the breakdown in the dollar yen or euro dollar. It spiked up a little bit and then printed that reversal. This was a little bit different, but the fact that it kept going, it was really stretched out. Like it was giving a great opportunity to find major divergence and reversal opportunities because it kept floating higher and higher and higher. And it wasn't necessarily doing what the dollar was. This is a dollar Swiss, and that was the reversal. On that reversal here, it was super obvious at that point. Again, I used two other indicators. Bandwidth is one of them. Percent B is another. Here's the divergence here on the 1 hour time frame for the CCI. You can clearly see, let me go over here and put the, on the last spike high, there's so much massive divergence. The fact that it kept going up and it was slowing down, I was tracking that. I mean, I was just waiting for the opportunity to print this. This one was very different than the dollar yen. So let me open this up and I'll show you. I'll open this up and show you where we got in. That was the reversal Tech 1 trade right there. It engulfed the last bullish candle. I didn't know that it was the last bullish candle, but again, I saw the reversal. I saw the resistance on the dollar. I saw that the dollar yen, or that the yen futures were also at support and about to change. Then when I saw the strength building and the volume levels building, it was all coming together. So this was all, these were all of the different areas that I was using or looking at to confirm the overall bigger picture that was going on here. Japanese yen futures. Dollar yen is hypersensitive to U.S. economic data and events like this. The dollar index, it was holding at resistance. All of this was coming together at the same time. And then clearly, again, when one particular currency pair starts to float higher, and then you see resistance like on a major indicator like the dollar, and it's not going anywhere, but this one you just wonder, like, why is it continuing? Why is it just continue to float? It's going to give me an opportunity to reverse quickly, to get a good solid reversal. It's just going to push higher and then stall and drop right back down again. That's how I look at these moves where they just float higher and don't stop. I stay away from them. I don't try to trade them. I know they're going to find resistance and then drop just like this eventually if the rest of the market is going to show me that confirmation, especially with a news event. So again, we were able to get into the trade like the euro dollar before the announcement, but it was pretty obvious what was happening. Again, collectively, the market has their opinions and their decision, their trade decision made up at that point. And it is like more and more and more and more as time goes on, people are starting to put on that position and starting to realize, hey, you know, whatever the case is, whatever, whether it's non-farm payrolls or, you know, Powell's statement or some kind of a, I know I use the U.S. a lot because I'm here in the United States, but it could be, you know, any European event, any, you know, like the votes that we had in the UK years ago, just Brexit. The same thing happens with Brexit when we're waiting for Brexit announcements and things like that. So it's all pretty much the same pattern. Again, Tech 1 trade, reversal, entry at 0.9864. The first target is going to be a psychological level. This is not where I'm taking the first 20 pips in a situation like that, like I do with the continuation breakout trade. This is not a continuation breakout trade. This is the Tech 1 trade. So I trade the Tech 1 either at reversals at support or resistance. In this case, it was a reversal. Or I trade a continuation breakout trade, let's say, after a breakout. If there was a breakout here and it moves up and then pulls back down and then prints, that's a Tech 1 trade, and then the trend resumes. I'll talk about that. I talk about that in the chat room when we see it. But that's not what this was. This was actually a reversal, and it was a Tech 1 trade. Again, the same thing that I pointed out with the euro dollar. If I don't have a good clean A, B, C price swing to use the Fibonacci tool correctly, to thereby look for extension targets, Fibonacci extension targets, then I'm going to have to trade to psychological levels. The psychological levels work over and over and over again. Now, when I got into the trade, I knew 50 was going to be my first target with an entry of 64. That's pretty close. That's not a whole lot. But as this started to unfold and then we got the data, the information we were waiting for, it was obvious that we could hold a lot longer. We continued to hold on to this trade. The next target was the 20 psychological level. And if it blows through the 20, and I say this in the chat room, if it tears off and just blows right through the 20 target, then obviously the next target is going to be the 00 level. And that's exactly what it did after his announcement and the market moved the way it did. It moved a little bit different. You can see the way these candles are, these 1 hour candles, as it was sort of unfolding. But at no point was there ever the thought that this is going to stall and stop and reverse prior to the announcement and then the announcement and then the drop. We could have held on to this a little bit longer. But when it hit the 00, getting in at 64, from 64 to the 00, I was flat. I was done. Usually right around a 00 number like this, if I'm, again, and I say this all of the time, if I'm in the chat room or if I'm trading by myself, it doesn't really matter. If I'm in a trade and I'm up 55, 60 pips, 48 pips, and I'm not really too sure exactly how much further it's going to go, or if I've got other positions that I think I need to manage, the other thing that I need to take into consideration is this is the dollar Swiss. The dollar Swiss does not always move as far as some of the others when they react. The others meaning the dollar yen or the euro dollar. I can get into a good continuation breakout trade or a good reversal on the dollar euro dollar, and sometimes the dollar Swiss won't cover the same distance. It won't go to the same expected take profit that I'm looking at on the euro dollar. It just stalls sometimes. It just doesn't move. You probably trade it and realized and seen the same thing. Not always, but very often when I trade it, that's sometimes what happens to me. So knowing which currency pair I'm trading and its sort of personality traits, I guess we could call it, not really, but that's the word I'm going to use right now. I know that this one can sometimes just do its own little thing. So again, 64 pips, not including the spread. So 61, 62, 60 pips profit on this trade, I'm locking it in. So when it hit the 00, I told everybody, you guys can hold for the next psychological level, again, which was 80 below the 00, or even 50 if it goes even lower. Some of my coaching students in the chat room did that. I didn't. I closed it here. I told them I was flat. That's my choice. But 80 was the next level, and then that's a psychological level, and then 50 was the next level after that, and it actually hit both. So some of my coaching students were able to do that, and as it was happening, some of them had never done that before, and I stayed in the chat room, and they're asking me, Joseph, should I, once it hits 80 and it goes down to 78 and spikes to 78 and then comes back up again, they're saying, what do I do? What do I do? I've never been up this much money. I've never made this many pips in one trade. Should I continue to hold it? And I told them, well, first of all, we go back to that one idea. And I talk about this a lot in the chat room, that when we get a move that's this big, here's where the statement was released. We got in before the statement. When we got in justifiably. Not it wasn't like a risky situation. We could clearly see the opportunity. But what I'm getting at is once the statement was released and we can see the strength across the board, yes, maybe it could stall. But if you're going to hold on to it, the other idea is that we wait for these candles to close. When we wait for the candles to close, remember how I talked about this earlier, very often in a situation like this, not all the time, if the conditions aren't optimum for this kind of what I'm describing, then it won't work. But with a situation like this, even with non-farm payrolls, if it's a big surprise to the market, it sort of behaves in the same way. Waiting for that 1 hour candle. So if a 1 hour candle's going to close at, let's say, 11 o'clock and it's 10:40, I know I've got another 20 minutes to wait on that candle. So I'm going to hold on to that candle another 20 minutes. And I want to see what it does towards the end of that 1 hour candle. Because very often it'll push a little bit lower and close towards the lows. In the other example, when I was explaining this, it was the euro dollar pushing towards the highs. So it's the exact opposite, but it works the same way. When we have a strong move like this, you have to be aware of what's going on, because this is a lot to process, right? When you're in a trade and you're seeing it moving up and down, you're thinking, I'm up 70 pips. I don't want to give it back. What do I do? That's your focus, but it shouldn't be your focus. Yes, you need to protect what you have, but you need to be aware of the mechanics, and you need to be aware of the driver of price here. What's going on? How are we reacting it? Is this really a big surprise? What else is the dollar doing? Where are volume levels? Is there a lot of people participating? These are the things that you need to be looking at, and they'll help you solidify your decision to get into a trade, but also to hold on to a trade so that you know what you're doing. You're not just like holding indefinitely because it's a random idea. These are some solid concepts that take place over and over again in events or situations just like this. Very often you see these 1 hour candles look just like this. Go look at those big events when it breaks out and look at the 1 hour candles and see where they close when there's a rally or trending move in that direction. So that's pretty much it. We can get into detail. If you want to learn more, you can join the chat room. I call out these trades for you live in the chat room. I walk you through these trades. I tell you exactly when I'm getting in and getting out. And I teach you exactly how to do this. There's also a lot of training and education in the chat room.